Here are some stocks that are falling outside of my portfolio. So for reference, this is my portfolio, and for today's video, I'll be covering stocks that are outside of my portfolio. So the first stock that I'll be covering today is a company that is called Transdigm. So Transdigm is down around 12% today, and it is currently trading at a 47 times earnings, post earnings of course. The stock dropped because it reported lesser than expected earnings as well as revenue. So this is Transdigm's business model. What they do is they acquire small businesses that have patents for all these different equipment. So for all your planes, for all your different aerospace equipment, there are patents attached to it. And what Transdigm will do is they will acquire all these small businesses that own these parts, and then they'll jerk up the prices by 4 to 5x, leveraging on the scale of the entire business. And for your aerospace industry, there is very high regulation, and that's why Transdigm's business model is more acquisitive as compared to creating the actual patent itself, because it will take years and years of regulation as well as R&D to bypass all this and get to the final product. So for Transdigm, it is a very interesting business, a highly monopolistic one as well. So for Transdigm, it is an interesting stock now, but I think what they're doing with their business model is a bit unethical. They buy over small companies and they jerk up the prices. The company has faced regulation scrutiny as well. And for me, I think Transdigm is a company that is too expensive at its current price, so I would stay out of this one for now. The next stock is Hims & Hers. So Hims & Hers is down around 8% today. It is currently trading at an 84 times earnings. So Hims & Hers actually reported their earnings. Their EPS was 17 cents as compared to 15 cents that was expected, so that was an earnings beat. But their revenues actually came in lower than expected. So revenues at Hims & Hers increased 73% in the second quarter from 315 million during the same quarter last year. Hims & Hers reported net income of 42 million compared to 13 million last year. So Hims & Hers actually tripled their net income this year as compared to last year. So it's incredible growth for the company. And besides that, Hims & Hers subscription business has just grown and grown and grown. So this quarter, for example, the subscription portion is actually up around 31%. There's still extremely healthy growth, and that's why a lot of investors are buying into Hims & Hers. But there is one worry when it comes to Hims & Hers, which is the GLP portion, the compounded drugs portion of the business. So what Hims & Hers has been doing is they're exploiting a grey area in the regulations. So what the regulation says is that if the drugs are basically customized for its consumers, if it's individualized, then Hims & Hers is allowed to sell them. So what Hims & Hers will do is they will create a 5-question questionnaire, and then they will customize the drug according to those questions that are being asked. So they're exploiting a loophole here, and over the next few months, if Novo Nordisk as well as the regulations start pressuring Hims & Hers as well as all these other small pharmaceutical companies from exploiting this loophole, then we could see revenues being hit because the GLP portion still makes up a significant revenue chunk of the entire Hims & Hers business. So for Hims & Hers, it is a speculative, complex business that retail is plowing their money into. It could be a multi-bagger for sure in the future, but for me, I think the risk is too high at this price. And for a company that is in your pharmaceutical industry as well as your healthcare industry, I think it is an avoid for me. The next stock that I'll be covering is Hims & Hers competitor, which is Novo Nordisk. So Novo Nordisk today is down another 2%. It is at its 52-week low. It is currently trading at a 13 times earnings, giving you around a 3.5% dividend yield. So for Novo Nordisk, the valuation is at a historical low. It's quite crazy how the stock just a few months ago was trading at a 50 times earnings, and currently now the stock is trading at a 13 times earnings. It has never gotten this low before in the history of the company, and that is why we're seeing some investors buying into Novo Nordisk today. But for Novo Nordisk, there is a headwind that is currently facing the business, which is Trump's policy of the most favored nation in terms of your drug prescriptions. So what he's saying is that the US are actually paying a lot more as compared to the other countries. Like for example, they pay 3 to 4 times more than other countries in Europe. And what Trump is trying to do is he's trying to lower down drug prices, which is overall good for your US healthcare. But when this happens, all your pharmaceutical companies outside of the US, Novo Nordisk included, will likely be hit by this, which will hurt the business in terms of the revenue as well. The company's valuation today is starting to price this in already, but if we see this policy being put in place firmly, then we could definitely see a 30 to 40% drop in terms of the fundamentals of the business. So we'll have to see how this one plays out as well. So for Novo Nordisk, the bull case for the company is number one, the sector tailwind. So your weight loss drug industry is projected to grow between 15 and 16% over the next 5 years, and Novo Nordisk being one of the market leaders will definitely be able to ride on this tailwind. And besides that, your Wegovy shortage has actually been removed already. So companies that sell compounded versions will no longer be able to do so. And for Novo Nordisk, if they pursue the case for all these different pharmaceutical companies, if they start suing them and start taking those ones down, this could be a tailwind for the company, especially since the Wegovy drug patent expires only in 2031. Same for their Ozempic weight loss drug. Next company is Berkshire Hathaway. So Berkshire, ever since its all-time highs in around May, has actually dropped by around 13%. It is currently trading at around a 20 times price to operating earnings, and the company is now underperforming the S&P 500. So for Berkshire, the company has stopped all buybacks. So this is the first quarter in a while that Berkshire hasn't bought back any of its shares, which is quite remarkable. And my feeling is that Warren Buffett thinks that the stock price today is expensive. And I don't disagree. If you have to look at the price to book of Berkshire Hathaway, the price to book is currently at around a 1.5 times. So historically, this is on the higher side. And the times where Berkshire actually bought back a lot of its shares was when the price to book dropped below 1.2 times. So if you're looking to buy into Berkshire, I think waiting for that 1.2 times price to book will be a decent entry if you're looking to invest in this one. So for now, I would stay out of this one. I mean, Berkshire is not buying back its shares already. I mean, Berkshire is clearly thinking that the stock is expensive. So for now, Berkshire is probably an avoid. The next company that is more interesting is FICO. So FICO in the past month is down around 30%. It is currently trading at a 52 times earnings at its 52-week low as well. So for FICO, if you don't understand the business model, what they do is they create the mathematical algorithms to generate the score for all these different credit bureaus. So for example, you have your consumers here, you have your banks, as well as your mortgage lenders. What your consumers will do is they will go to the mortgage lenders and they will try and get a loan. And when a consumer wants to get the loan, what happens is your banks, they have to assess the credibility, the credit score of the consumer. And so they'll go to the credit bureaus and ask for a report. And what happens then is FICO will supply its mathematical algorithm to all these different credit bureaus. Then from there, the credit bureaus will package the score and then upsell it to the mortgage lender, which will then pass on the cost to the consumer. So for FICO, it's like a franchise business. They have basically no cost other than the capex that they put in to build out all these algorithms. And for this company, it is a high margin recurring revenue business. And besides that, they also have the software department as well, which creates the entire ecosystem as a whole. So for FICO, it has incredible pricing power. So this year, they actually hiked the prices from $3.50 to around $4.95. That's around a 40% increase. And for 2026, the estimated price hike will be up to $6.50. And that represents a 30% increase in terms of the scores pricing. So even without volume growth, if volume remains stable, the company can easily grow its revenues by 30% if it jerks its price up by 30%. And besides that, the mortgage market in the US has been weakening over the past few years because of high interest rates. So if we see that portion recover, then you could definitely see volume increase on top of the price increase for FICO as well. So for FICO, the stock is down because FHFA came out and said that VantageScore will be allowed to be used for your mortgage lending as well. So FHFA allowing VantageScore for your government-sponsored enterprises, which is 1/3 of FICO's B2B business. So FICO has B2B as well as B2C. B2B makes up 2/3, B2C makes up around 1/3. And this mortgage portion is actually 1/3 of that 2/3. So what this means is that if FICO loses out the entire mortgage portion, then they will lose around 20% of their revenue. So let's say hypothetically, if the company loses a 10% share, they currently have around 90%. So let's say if they lose another 10%, that would mean a 2% decrease in terms of the revenue. So I think this is a bit overblown in terms of the reaction of the stock price. I mean, the company has dropped around 30% ever since Bill Putte came out with that statement. It is a possible overreaction despite the high valuation. And for FICO today, I think it is a company that is trading at a decent price. So for FICO, it looks interesting. The margins will keep improving with price increases, and your mortgage sector is starting to recover as well. So they have a target on their back for now, but I expect the CEO to be able to handle this. The CEO has been around with the company since around 2012, and he was the one that created the pivot to increase prices and increase profitability for FICO. So I expect him to be able to execute well. And so for FICO, I think at today's price, the stock is getting interesting. The next stock that I'll be covering is one that has been floating around in my comments. So this stock is actually Duolingo. So if you didn't watch Joseph Carlson's video, he actually bought into Duolingo, and I've seen some comments about the stock. So for Duolingo, in the past 3 months, the stock is down around 40%. It is currently trading at 168 times earnings. And for Duolingo, if you don't know what the app is, it is sort of like a game that teaches you how to learn a language. But this is purely anecdotal. I think for Duolingo, their current user base will eventually grow out of the app itself. I mean, I had people around me in the past that was previously using the app, and they've now grown out of it. And besides that, Duolingo actually tricks people into signing up for the subscription portion. So there's something called a streak in the app. And once you've broken the streak, the only way for you to restore it is to subscribe to their monthly payment portion. And that is what Duolingo has been doing for its users on the app. And for this company, I think it is trading at an extremely high valuation. Although it is growing rapidly, I view this as a company that is at risk of AI as well. So for example, you had Google coming up with Google Translator, and you had Google Meet Translator as well. So with AI improving and with AI coming up with all these different translation models, I think for Duolingo, they will lose the portion of the customer base that wanted to learn a different language outside of having fun on the app. So for this company, I would avoid it for now. I think it is a company that is super expensive, super volatile, and for now, this is an avoid for me. Next portion, I'll be covering some questions. So the first one, it says, why don't you own Grab? So why don't I own Grab? Grab is a company that is currently still speculative. It is similar to Duolingo. It doesn't have a history of strong earnings. I mean, in the ride-hailing space, I think the better company would be to just invest in Uber. And for me, I think Uber is a company that is expensive. There's a company that doesn't have a very sustainable moat. And with robotaxis coming up in the future, this could hurt Uber's market share as well as Grab. So for now, I think Grab is an avoid for me as well. Similar to Duolingo, it is in the too hard pile. The next question, it says, hi Guan, how do you think about Cha as well as this other company called Asloy? Chagee's current PE ratio seems low despite its current growth rate, and Asloy is one of the largest company in your eyewear industry. I'm not too sure what Asloy does, but I can speak about Chagee. So for Chagee, what they've been rapidly doing over the past few years is they've been trying to internationally expand and to open new stores in many different countries. So for example, in Singapore, you will see a Chagee in almost every other mall. But for all these bubble tea companies, they will eventually die out over time. I mean, you've seen a lot of different bubble tea companies coming in and going out. And for me, a company like Chagee in the food space doesn't have a very sustainable moat, similar to Duolingo, similar to Grab as well. So for me, despite the low valuation and the high growth rate, supposedly, Chagee is an avoid for me. I think a better company in the space would be MeShare. The company is vertically integrated, unlike Chagee, and the company probably has a lot more growth ahead of it. And the company is a lot less mature as compared to Chagee, so you can expect a lot more growth ahead of it. I hope you guys have found this one useful and invest safe.